Hello and welcome to another video. It's been a big week and I want to start with some of the numbers that came out. It is reported that US ISM manufacturing PMI is currently at 48.7%, and this is what they say in the report. The US manufacturing sector contracted in August for the sixth consecutive month after 2 months of expansion preceded by 26 months of contraction. The manufacturing PMI registered 48.7%, which is 0.7 percentage points higher compared to the 48% reported in July. And here I have put the table on the right side that you can pause the video and see yourself, because what I really want to do is to move forward and actually talk about what respondents are saying. 50% tariff on imports from Brazil, combined with the US Department of Agriculture's elimination of the specialty sugar quota, means certified organic cane sugar and everything made with it is about to get significantly more expensive. Tariffs continue to wreak havoc on planning and scheduling activities. New product development costs continue to increase and unexpected tariff increases are announced. For example, 50% duties on imports from India, an increase to all countries up from original 10%. Our materials and supplies are now rising in price, so our sale pricing is again being reviewed to ensure we keep a sustainable margin. Plans to bring production back into US are impacted by higher material costs, making it more difficult to justify the return. And this is where it really gets interesting. The trucking industry continues to contract. Our backlog continues to shrink as customers continue to hold off on buying new equipment. This current environment is much worse than the Great Recession of 2008 and 9. There is absolutely no activity in the transportation equipment industry. This is 100% attributable to current tariff policy and the uncertainty it has created. We are also in stagflation. Prices are up due to material tariffs, but volume is way off. I'll skip the next one and move straight to the last one, because that one seems to be the most interesting to me. We have implemented our second price increase, quote unquote, made in the USA, has become even more difficult due to tariffs on many components. Total price increase so far 24%, that will only offset tariffs. No influence on margin percentage, which will actually drop. In 2 rounds of layoffs, we have let go of about 15% of our US workforce. These are high-paying and high-skilled roles: engineers, marketing, design teams, finance, IT, and operations. The administration wants manufacturing jobs in the US, but we are losing higher-skilled and higher-paying roles. No stability in trade and economics, capital expenditures, spending, and hiring are frozen. It's survival. And so this is interesting because this is what I've been saying for months and months now. It doesn't make sense to move to USA to do business, right? Because at the end of the day, if it's much cheaper in Asia, let's say, to produce a phone or a widget, whatever it is, then why would you move to USA? Because at the end of the day, you want to make some profit when you supply the market. But it doesn't make sense from a business perspective to supply the market where your margin is zero or below zero, right? So so all these costs, whether you like it or not, will most likely and for the most of the part will be transferred to the consumer. At the same time, consumer is completely maxed out, and what's going to happen when those tariffs will be implemented in the price increase is that at some point people won't be able to afford goods and services or utilities, whatever it is. And what's going to happen, I think, is that the Fed essentially will start another QE program, or whatever the hell it's going to name it, which essentially means that the dollar purchasing power will decrease. Because remember, if there's expansion in money supply and credit, that creates inflation, and then the inflation creates higher prices, which is the effect of the inflation, right? So that essentially means you'll be able to buy less for more dollars. But anyways, I want to move on and talk a little bit about US unemployment. The unemployment rate is now at 4.3%, which is 0.1% change month over month, right? In the report, they said US non-farm payrolls rose by 22,000 in August 2025, well below an upwardly revised 79,000 in July, and market forecasts of 75,000 underscoring signs of a cooling labor market. And Trump keeps saying that the labor market and U.S. economy is booming. On what earth does a good economy have a contracting employment, right? But what I encourage is to actually look at the U6 numbers, because unlike a U3 number, U6 number is actually a broader version how to measure unemployment level, at least in USA. And basically, in U6 number, unlike U3 number, it's a broader measure of the unemployment, because in U6 number, they actually account for people that haven't found a job in the past 12 months, unlike in U3 number, as well as they account for the people that actually have a part-time job but want and are available for the full-time job. And if you're a Federal Reserve and you keep talking about being data dependent, why not look at U6 number, which is 8.1%, rather than U3 number, which is only 4.3%, right? So I think it's all actually nonsense, because U3 number is undermining the more realistic number, which is 8.1. So why not just use U6 number rather than U3 number? It just makes little to no sense at all to me. But anyways, I quickly want to talk about housing market emergency that Trump essentially wants to announce possibly sometime soon. And here I have put a couple of points that would explain why there is actually a housing crisis in USA. The US is facing a severe shortage of affordable housing, estimated at 4 to 4.7 million units nationwide, with the worst deficits in high-demand areas like New York, Los Angeles, and other coastal cities. Post-2008 financial crisis, home construction never fully recovered, exacerbated by COVID-19 related supply chain disruptions, labor shortages, and local zoning laws that restrict new builds. Median home price hit 443,000 in July, while rents have surged, leaving nearly half of renter households cost-burdened. High interest rates have locked in low-rate homeowners, reducing inventory. Trump's tariffs on imports like Canadian lumber and steel have inflated building material costs, adding to the problem. But wait, this is the best part. Regulatory costs, which include complying with building code, zoning issues, permitting roadblocks, and other costly challenges, make up nearly 25% of the cost of building a single-family home and more than 40% of the cost of a typical apartment. And also, here's a study that I found from 2021. On a dollar basis applied to the current average price, $394,000 of a new home, regulation costs account for $93.8 thousand of the final house price. Of this, $41,000 is attributable to regulation during development and $52,500 due to regulation during construction. That is insanity, and that is what happens when a government gets involved in all sorts of private business and whatnot. Everything just becomes more expensive, and they usually achieve the opposite of what they're trying to achieve. And if we remove the government from the private businesses, or we deregulate the markets, your single family home price would decline by 25%. On a $400,000 home, that would be about 100 grand. It would just completely would go down, which already would make the housing more affordable. Or even if it's apartment, that would be about 40%, just if we deregulate the actual sector. But what would also happen if US government privatizes Fannie Mae and Freddie Mac? I think it would simply make the US housing even less affordable rather than more affordable. But we'll see how the things play out. Anyway, here is what we could actually do to reduce the housing prices. We could repeal or federalize local zoning to allow market-driven development, such as upzoning single-family areas for multifamily units, tiny homes, or modular constructions. Streamline permitting to reduce costs and eliminate subsidies for sprawl. Phase out the mortgage interest deduction. Eliminate capital gain tax breaks for home sales and impose uniform property tax without exemptions for investors. oppose expansions of public housing or emergency declarations that enable eminent domain or federal land grabs. Instead, privatize underused federal lands through auctions, allowing entrepreneurs to develop affordably. And also, what I mentioned earlier is to reduce regulation, get the government out of the way, out of the private sector, so that business can handle itself, and thus bringing the prices down by competing against each other. But anyway, let's move on. I want to talk about gold. Not only it broke out from 3500 resistance level that we had previously, but it also broke out from 3600, currently standing at 3639. There is also a very similar situation in senior gold miners, right? Last time it was that high was in 2011, right? But if you actually look at individual companies like Agnico Eagle and Newmont and Franco-Nevada, those companies are still relatively cheap to the gold price because their profit margins are now much, much higher than they used to be, let's say, 1 or 2 years ago, or even 3 or 4 years ago, right? And so they're still relatively cheap. And here's an interesting thing that Goldman Sachs said. US President Donald Trump's war against Federal Reserve may send gold price to as high as $5,000 an ounce by driving down investor confidence in the dollar. In a note published Thursday, the bank's analyst warned that Trump's attempt to interfere with the US central bank could further erode trust in dollar-denominated assets, thereby adding to gold's safe haven appeal. So essentially, it's not only China or BRICS countries that are trying to diversify away from dollar. It's also Poland. Adam Glapinski, the governor of Poland's central bank, said, "I intend to present in the near future a proposal to raise the threshold. We are aiming for 30%. Previously, it was 20% of the reserves. What happens next, we shall see." And it's not only them. It's also El Salvador. Central bank demand for gold may have slowed through the summer, but official purchases remain a dominant force in the market. El Salvador underscored this trend as its central bank just boosted its gold reserves for the first time in 3.5 decades. The Central American country announced Thursday that it bought 14 troy ounces of gold, valued at $50 million. In a press release, the bank said the purchase was part of the medium and long-term strategy to diversify and strengthen international reserves. With this acquisition, El Salvador's gold holdings rose from 44,000 ounces to 58,000 ounces. With a total estimated value of $207 million, it is the country's first gold purchase since 1990. And so, regardless of how you feel about Russian-Ukraine war, you need to remember that US confiscated about 300 billion worth of US treasuries from Russia, which actually sent the signal abroad by saying, hey guys, if you don't do things how we want, what we want, when we want, and the way we want, well, this is what's going to happen to you. And hence, that's what I think the diversification from US dollar is all about. It's just getting somewhere safe. It's something that they have no control over and they can't do anything about it. But anyways, that's it for this video. Thanks for watching. Don't forget to like and subscribe if you find this helpful. If you think somebody else could learn something from this, don't forget to share it. Peace.